Welcome back to Accounting 101. In this video, we're going to talk Chapter 5, Accounting for Merchandising Operations. So far, when we've talked about revenue in different examples in the first few chapters, we've talked about service revenue. Okay, we've touched briefly on selling items, but really not talked about how do you account for selling merchandise. So that's what we're going to be doing in this chapter. So the learning objectives are to describe merchandising operations and inventory systems. We're going to see how we record purchases under perpetual inventory system. How do we record sales under perpetual inventory system? Then we're going to apply the steps in the accounting cycle to a merchandising company and prepare a multi-step income statement. So what is merchandising operations? Merchandising companies, examples of REI, Walmart, Amazon, they buy and sell goods. So they're in the business of selling goods more than providing services, although they can do both. If you look at a retailer example here, Office Depot, they're going to buy goods from a wholesaler, in this case United Stationaries. They're going to put it in their stores. They're going to try to sell it to the consumer, and the consumer is the ultimate person or the ultimate end goal of where we're trying to sell these goods. The primary source of revenues is referred to as sales revenue or simply sales. If we look at some new concepts here, we'll get more in details when we talk about the multi-step income statement. We'll come back to this kind of model. But the cost of goods sold is a new concept that we haven't seen before. That's the total cost of merchandise sold during the period. So if we take our sales revenue, what we get from selling the goods, less the cost of those goods, so cost of goods sold, that's going to equal our gross profit. We then subtract our operating expenses and we get our net income. Okay, again, when we talk about the multi-step income statement, we'll get into more details of how this flow operates. But new concepts that we have here is that this cost of goods sold concept, since we're selling goods, we have a cost associated with those goals and we account for those as well. Operating cycle of a merchandising company is ordinarily longer than that of a service company. So in the top graphic there, we talked about this before. Service company, we have cash, we're going to perform services, pay our workers. When we perform those services, we're going to have accounts payable from our customers. Those customers are going to pay us in the future. We receive the cash and we're back to cash. So remember, the operating cycle is cash to cash. Under a merchandising company, we have cash. We're going to buy inventory that gets shipped to our location. We're going to hold that inventory. We're going to try and sell that inventory. Once we sell that, we have accounts receivable, assuming that we sell on credit. And then in the future, we'll receive that cash from customers. So it's a little bit longer because we have this inventory and then holding that inventory and trying to sell it. So the operating cycle is a little bit longer. How do we determine what the cost of goods sold is? Well, this is a way that we can do it. We're going to take our beginning inventory, so the amount of inventory, the amount of goods that we had on hand at the beginning of the period. We're going to add to that any new purchases we make. So beginning inventory plus purchases, that's going to give us our goods available for sale. So that's what we have available that we can sell to our customers during that period. The goods that are not sold by the end of the accounting period are our ending inventory. So we're going to subtract our ending inventory, and that's going to give us our cost of goods sold for that period. So beginning plus purchases is what's available. Subtract our ending, and we get our goods sold. This formula we're going to see over and over throughout the rest of the chapter, or throughout the rest of the book, and some other concepts as well. But beginning plus purchased is what's available, minus ending is cost of goods sold. As we saw even in the first chapter, some of the homework probably will give you some of these, but not the others, and you have to find the missing one. So, a simple one is if you have what's available. If you subtract your cost of goods sold to get your ending inventory, so that's a easy one that can swap out. So just be aware that this formula you're going to see um, either exactly like this or similar ones in the future. And this formula works for both um, the value, so the dollars, and the number of units. So if you add up units, you can use the same formula. We see more of that in, I think, chapter 6 when we talk about the different types of inventory systems and how you account for inventory. Perpetual system. There's two types of inventory systems you can have, a perpetual system or a periodic system. Most of what we do is based on the perpetual system. So a perpetual system maintains detailed records of the cost of each inventory purchase and sale. It records continuously, the records continuously show inventory that should be on hand for every item. The company determines cost of goods sold each time a sale occurs. So they know exactly what the inventory is every time there's a purchase or sale that you impact that inventory account. So at any time you can run a report and know what you should have on hand. And each time you sell it, you're going to show the cost of goods sold. Under a periodic system, do not keep detailed records of goods on hand throughout the period. The cost of goods sold determined by count at the end of the accounting period. So if you think back to that formula we saw a couple of slides ago, you're going to get what's available. You're going to do a count at the end of the period to find out what's in an inventory, and then do the subtraction to get your cost of goods sold. So again, that formula, beginning plus purchases minus ending is our cost of goods sold. Here's a graphic of the two systems. So under perpetual, you're going to record purchase of inventory when you purchase it. Each time you sell an item, you're going to record revenue and compute and record cost of goods sold. At the end of the period, you shouldn't have any entry. Under a periodic system, purchase the inventory that's similar. When you sell the item, you're only going to record the revenue portion. You're not going to record the cost of goods sold portion. And then at the end of the period, you have to do a calculation to figure out what the cost of goods sold is and do the entry to record it. Advantages of the perpetual system. It's traditionally used for merchandise with high unit values. Shows the quantity and cost of the inventory that should be on hand at any time, and provides better control over inventories than a periodic system. With the computer systems and most of the companies operating an automated system, even low unit values can benefit from a perpetual system, and it's easier to do. If you're doing this all manually and having to do manual entries and that type of stuff, if you're selling screws, for example, you're going to have a lot of volume and very low cost and low revenue. You might not want to do a perpetual system if you're doing it manually. But again, with computer systems and the way everything's mostly automated now, it's easier to do, and it's just a better system than the periodic system. So here's an example of Moro snowboards. Investors eager to invest in a company that has a hot new product. So Moro Snowboards, which is now part of K2 Sports, issued shares of stock to the public for the first time. Some investors expressed reluctance to invest because of a number of accounting control problems. So what Moro did is they implemented a perpetual inventory system to improve control over inventory. In addition, they stated that it would perform physical inventory count every quarter until it felt that its perpetual inventory system was reliable. So if a perpetual inventory system keeps track of inventory on a daily basis, why do companies ever need to do a physical count? The system keeps track of all sales and purchases on a continuous basis. That provides continuous record of the number of units in inventory. However, errors are made, so you can make an error recording a sale or a purchase. There could be theft. You could have returns and you don't record that correctly. So there's a number of things that could cause your actual true physical inventory be different than what your system says. It's greatly reduced with the perpetual system, but it happens. So all companies do a physical count of inventory at least once a year. Most companies, it's an audit requirement. So the company I currently work at, we're going to do 2 counts here in November and December, one for our finished goods and then one for our work in process and raw materials. We shut down the plant for a day or two to count it, so there's less inventory movement going on, and we count everything that we have. The auditors will be on site. They will monitor what we're doing, and they'll do their own test counts. So that's a normal process. In the process that Morrow went through, where they were doing it quarterly until they got Reliance, is also a good best practice. You know, I've had companies where we've had thresholds. So if you're, for example, 97% or better, you only have to do it once a year. If you fall below 95%, you have to do it twice. If you fall below 93%, you have to do it every quarter. Things like that. So as you get less accurate, then you have to do counts more often. So that just gives the discipline into making sure we're taking care of our inventory and recording things properly. So true or false? The primary source of revenue for a merchandising company results from performing services to customers. That is false. The primary source for merchandising company is selling goods. The operating cycle of a service company is usually shorter than that of a merchandising company. That is true. Service company doesn't buy and hold inventory and then have to sell that. So that is taken out of the operating cycle. Sales revenue less cost of goods sold equals gross profit. Remember back to the slide earlier, that was the formula that we looked at, so that is true. Again, we'll see more of that when we talk about the multi-step income statement. Ending inventory plus the cost of goods sold, ending inventory plus the cost of goods purchased equals cost of goods available for sale. That is false. It's beginning inventory plus cost of goods purchased equals cost of goods available. Now this is a little tricky because the ending inventory of period 1 becomes the beginning inventory of period 2. But if you're doing the calculation, you use the term beginning inventory, which is what you have at the start of the period. So now we'll look at recording purchases under a perpetual inventory system. Purchases are made using cash or credit, so on account. They normally record when goods are received from the seller. Purchase invoice should support each credit purchase. So we have a look at this. The top here, PW Audio Supply is the seller. It's sold to Sauk Stereo. It's got their address. It's got the date of the sale, who the salesperson is, terms, this crazy looking thing here. We'll talk about that in a little bit. FOB shipping point, we'll talk about that again in a couple slides. It tells you what you bought. So we have a catalog number, description, quantity, the price of each, and then the extended price, and then the total amount of the sale. So Sauk Stereo, the buyer, uses as a purchase invoice the sales invoice prepared by PW Audio Supply, the seller. Okay, so it's the same one invoice, and they use it. The seller's going to use it for the sales invoice. The buyer is going to use it as their purchase invoice. So what would be the journal entry for Sauk Stereo, again the buyer, for the invoice from PW Audio Supply? entry is going to be a debit to inventory and a credit to accounts payable. So they bought this on credit, so they're going to pay for it in the future. So we have a liability, accounts payable. We credit that to increase that liability. We're receiving goods that we're going to sell. And what we do is we account for that in the account inventory. So we're increasing our inventory. We're going to debit that account inventory. Freight costs. Freight costs incurred by the seller are an operating expense. How do we determine who pays for the freight? So that FOB that we saw on the invoice, we'll go back a slide. It says FOB shipping point. That's the shipping term. So FOB shipping point means the buyer pays the freight costs. In FOB destination, the seller pays for the freight costs. So what do those terms really mean? So FOB stands for free on board. So it's just a shipping phrase or term. Free on board shipping point means that the seller is offering the goods at the shipping point. That's where the ownership passes to the buyer, and the seller has no further responsibility after the shipping point. So the buyer has to arrange the shipping. They have to pay for getting a truck there and shipping the goods to themselves. FOB destination, so free on board again. Free on board destination is that the seller is offering the goods at the all the way to the destination. So the seller continues to own the goods while it's in transit. The buyer actually takes possession and ownership when it gets delivered at their location, and the seller pays for the freight. So we'll look at some entries related to this. Assume upon delivery of the goods on May 6th, Sauk Stereo pays Public Carrier Company $150 for freight charges. Sauk Stereo would record the entry. Again, they're the buyer. They're paying for the shipping costs. The shipping costs go into inventory. So we're going to debit inventory, credit cash. So why do we use inventory? Because the cost of our inventory includes the cost of shipping. So we add those costs into our inventory, and it's part of the cost of buying those goods. If the freight terms were FOB destination instead of FOB shipping point, PW Audio Supply, the seller, would have to pay the freight charges of $150. When the seller would pay that, their entry would be freight out or delivery expense. So they're going to record an operating expense for that $150 and credit cash. So the seller records it as an operating expense. The buyer, when they pay the freight charges, they record it as part of inventory. Purchase returns and allowances. So a purchaser may be dissatisfied because goods are damaged or defective, inferior quality, do not meet the purchaser specifications. So a few reasons why there may be a return or an allowance giving. A purchase return is when the goods are actually returned to the seller. So it's returned for credit if the sale was made on credit. If it was made, the purchase made for cash, you get a cash refund. A purchase allowance, so the buyer may choose to keep the merchandise, or the seller may offer them to do that, and the seller will grant an allowance or deduction from the purchase price. So if there's goods that are of a lesser quality, but they're still decent, and the seller or the buyer thinks they can sell that to their customers, they may contact the seller and say, this is not what we ordered or thought we were going to get. We don't want to pay this much for it. We'll hang on to it if you give us a discount of X amount. The seller probably will allow that or kind of agree to that because then they don't have to worry about shipping the goods back to themselves and putting that in their inventory and so on. So sometimes they just give an allowance for the goods and the buyer keeps the goods. So look at an example here. Sock Stereo returned goods costing $300 to PW Audio Supply on May 8th. The goods were purchased on credit. So how does Sock Audio record that transaction? We're going to debit accounts payable for the 300 and credit inventory 300. So it's just the opposite of what we recorded when we bought the goods. Now we're returning those goods. We just do the opposite entry. We reduce our liability because we don't have to pay for those $300 worth of goods. And since we don't have it, we shipped it back to the seller. We reduce our inventory. In a perpetual inventory system, a return of defective merchandise by a purchaser is recorded by crediting which of these accounts? Purchases, purchase returns, purchase allowance, or inventory? We just saw that example. The answer is inventory. Next, we'll talk about purchase discounts. So credit terms may permit a buyer to claim a cash discount for prompt payment. Some advantages of doing this is the purchaser saves money, so they're paying less for their goods ultimately. From a seller's perspective, it shortens the operating cycle, so you convert accounts receivable into cash more quickly. So credit terms may read 2/10, N/30. That's just one example. What does that mean? Or how do we read that? We actually read that as 210 net 30. That's how you would see, if you saw that on an invoice, that's how you would think about what that means. What do all those numbers mean? So 210 net 30, you get a 2% discount if paid within 10 days. If you don't take that discount and pay within 10 days, the net amount is due within 30 days. So that's 210 net 30. Another example could be 110 EOM. So it's 110 end of month. A 1% discount if paid within the first 10 days of the next month. And then the other example is N10 end of month. So net 10 end of month. Net amount is due within the first 10 days of the next month. So there can be any combinations kind of listed the same way for credit terms. So you could have 1.5, 5, and 45. So 1.5% discount in 5 days, or the net in 45. So anything you can think of, a combination, it probably could be used as credit terms. These terms are agreed to, negotiated between the buyer and the seller. So they both agree to what the terms are going to be. You can't just arbitrarily make it up. You have to make sure the buyer and the seller both agree. But we'll look at how you account for this discount if you actually take it or if you don't take it. So the balance due is $3,500. So how do we get that? It's the gross invoice price. So what was on the invoice of $3,800. We made a return, so that $300 reduces the amount that is owed. So we have $3,500 owed. On May 14th, the last day of the discount period, SOC is going to pay that balance. What's the entry that SOC makes on May 14th to record the payment? So we've seen before that when you make a payment on account, you're going to relieve the liability, decrease the liability. We do that by debiting the liability, in this case accounts payable, and we're going to reduce our cash, our asset, and we are going to credit cash for that. So it's going to be that same concept, but we have this discount. So it's a 2% discount on the balance that's left. So the $3,500, so it's after the returns, gives us $70. The entry we make is this. We're going to debit accounts payable for the full $3,500. That's what our liability is on the books for this transaction. We're going to, since we're paying it off, we're going to relieve that full liability. But the cash we paid is going to be reduced by the discount amount. So we're going to have that reduction of $70 in the cash paid. So the cash paid is only $3,430. And we're going to reduce our inventory by the amount of the discount. Okay, so we credit inventory 70. Why do we credit inventory 70? Because ultimately what we're doing with taking this discount is reducing the price we paid for the inventory. So we recorded the inventory at the 3,500. We actually paid less than that, so we reduce our inventory by the $70. Now we'll look at that same transaction, but we failed to take the discount. So we didn't pay within 10 days to be able to take the discount. We still owe that $3,500. We're going to pay the full amount. That's simply going to be debit accounts payable, reduce that liability, $3,500, and reduce our cash, reduce our assets, credit cash, $3,500. All right, now thinking about should we take the discounts when offered. So if we pass up the discount, you can think of it as paying interest for the use of the money. Okay, so passing up the discount offered by PW Audio Supply would be comparable to Sox Stereo paying an interest rate of approximately 36.5%. That's a very high interest rate. So if you have the cash available, you're probably going to take the discount. If you don't have the cash available, most likely you can go get a loan for less than 36.5%. Usually significantly less than that. So it may be worth even to go borrow money to take that discount. Okay, how did we come up with the 36.5%? So remember it's 2% discount if paid in 10 days, net in 30. So we're getting 2% off of our purchase price for 20 days. That equals the annual interest rate of 36.5%. We calculate that by the 2% times 365 divided by 20, and that's how we calculate the annual interest rate. Okay, so the discount interest, 2%, is not a interest rate. It's just the discount rate. To get the interest rate, you have to do this formula. So that discount times 365 divided by the number of days between the discount and the net. So in this case 20, but if it was 210 or 215 net 30, it would only be 15 days, so it would get a different amount. And that's how you get the interest rate. So inventory. We learned this about this new account. We saw some transactions in here. So if we look at just everything related to this one purchase, we made a purchase on May 4th, so we debited inventory $3,800. On May 6th, we paid freight. We added that to inventory, remember? So we debited inventory. On May 8th, we had a return, so we reduced our inventory by $300. And then on May 14th, we took the purchase discount, so we reduced our inventory again by 70 with the credit. So our balance is $3,580. So the cost of that inventory is $3,580 after we made all of our transactions. So we added the cost of the freight, we reduced the inventory value by the purchase discount, and again, when we had the return, we took that out of our inventory as well. Another example here, September 5th, De La Hoya Company buys merchandise and account from Juno Diaz Company. The selling price of the goods to De La Hoya is $1,500. The cost to Diaz was $800. On September 8th, De La Hoya returns defective goods with a selling price of $200, record the transactions on the books of De La Hoya Company. So the first thing we have to determine is, are we looking at the transaction from the buyer or the seller? Okay, since we're looking at purchase transactions, it's the buyer in this case, but just know when you are doing your homework and looking at different examples, make sure you're understanding, are you the buyer or the seller? So De La Hoya is the buyer in this case. We made a purchase of 1,500. That entry is debit inventory 1,500, credit accounts payable 1,500. On September 8th, we returned defective goods that was worth $200. Again, when we record the return, it's just the opposite of what we did on the purchase. So we're going to debit accounts payable, credit inventory for the return of $200. Now we'll talk about recording the sales under perpetual inventory system. So again, we're going to use the same example, the PW Audio selling to SAUK Stereo, but now we're going to look at it from the perspective of the seller, PW Audio. So sales are made on cash or credit, same thing. Sales revenue, like service revenue, is recorded when the performance obligation is satisfied. So whenever we are, have made that, finished that obligation of delivering the goods to the buyer, performance obligation is when it transfers. So depending on the term, shipping point or destination, and the sales invoice should support each credit sale. So journal entries to record a sale. The first one is the recording the sale at the selling price, so cash or accounts receivable, and we're going to debit that and then credit sales revenue. Okay. We have a second entry that we have to make because we're assuming we're under perpetual inventory system. We're going to debit cost of goods sold and credit inventory. So cost of goods sold is the new account. It's an expense account that goes on the income statement. Normal balance is debit, so we're debiting that, increasing our expense. We have sold inventory. We've gotten rid of it, shipped it to the buyer. So we're going to reduce our inventory with a credit. That is done at the cost of the inventory, not the selling price. So you can see here the selling price should be higher than the cost. That difference is going to be our gross profit. We saw that earlier, and we'll see it again when we talk about the multi-step income statement. So we have this sale from PW Audio to SAUK Stereo, $3,800 on May 4th. And now we need more information because we're the seller. We need to know what the merchandise cost, the seller, PW Audio. So in this case, it's $2,400. When we make that sale on May 4th, we have two entries we do on PW Audio, the seller's books. We're going to record accounts receivable with the debit of $3,800. Record the sales revenue, credit sales revenue $3,800. We also have an inventory cost of goods sold entry we have to make, so we're going to debit cost of goods sold $2,400 and credit inventory $2,400. So another fraud example. Holly Harmon was a cashier at a national superstore for only a short time when she began stealing merchandise using three methods. So her husband or friends took UPC labels from cheaper items and put them on more expensive items. She then scanned the goods at the register. Using the second method, Holly scanned an item at the register but then voided the sale but left the merchandise in the shopping cart or the bag. Third approach was to put goods into a large plastic containers. She scanned the plastic containers but not the goods within them. So after she quit, a review of past surveillance tapes enabled the store to observe the thefts and identify the participants. They took $12,000 worth of goods. So a couple of controls were missing And in Chapter 7, we get into more controls in that, but as we said before, we're going to see some of these along the way because it's always good to talk about controls. Two controls that we're missing are human resource controls. So if they would have done a background check, they would have figured out that Holly's previous criminal record. So if she had a criminal record, she probably shouldn't be a cashier. Physical controls. Software can flag high numbers of voided transactions or a high number of sales of low-priced goods. So there might be some, flags there, and then random comparisons of video records with cash register records can ensure that goods reported as sold on the register are the same goods that are being purchased on the video. And employees should be aware that they are being monitored, so they will act more ethically. You would hope they would act ethically anyway, but some people don't. Okay, sales returns and allowances. This is the flip side of purchase returns and allowances. It's a contra revenue account to sales revenue. Okay, remember when we talk about contra accounts, it has the opposite normal balance and the opposite increase from the account they're contra to. So if it's contra to revenue, revenue has a normal credit balance and increases with credits. The sales returns and allowance account is going to have a normal debit balance and increase with a debit. We use this separate account, the sales returns and allowance account, and not reduce sales directly because it would obscure the relative importance of sales returns and allowances as a percentage of sales. So that's a key metric that companies look at is what percentage of our sales do we get returned. And it could distort comparisons between total sales in different accounting periods. So if you have a period with high returns, may relate to a prior period. So if you are debiting that sales account directly, you're going to lose some comparisons. So we have some not defective goods that are being returned. So prepare the entry PW Audio Supply would make to record the credit for returned goods on May 8th. Had a selling price of $300, and we're going to assume a $140 cost. Now, this is the same return we saw from SOC Audio's perspective earlier. They returned some goods. From the seller side, here's the entries we would make. We would debit our sales returns and allowances, so this new account. We would credit accounts receivable. So the customer no longer owes us that, so we're going to reduce our asset of the amount that they owe us. Instead of reducing sales, again, we're going to debit this new account, sales returns and allowances. Now that we're having merchandise return, we have to worry about inventory and cost of goods sold. So we're going to debit inventory, credit cost of goods sold. This is non-defective goods. So we're going to put that back in the inventory. We can resell those goods. So we're going to show that back in inventory at the cost of those goods. And then again, we reduce our cost of goods sold because it's not really a sale anymore. Now let's assume that the goods that were returned were defective. Okay, if we return defective goods, it's going to have a lower fair value than the original cost. So in this case, we've determined that the fair value is $50 instead of the $140. So entries we make are going to be the same. We're going to debit sales returns and allowances for the full selling price of $300, credit accounts receivable for that same amount, $300. Inventory, we have a inventory back in our stock, but it's defective, so it's not worth the $140 that we saw before. It's only worth $50, so we're going to put it in inventory at $50 and credit cost of goods sold for that $50. Okay, so that's the difference between a defective good and a non-defective good on a return. Now let's talk about the allowance part of this. Assume Stock Stereo does not return the goods, but PW Audio grants the buyer an allowance by reducing the purchase price by 100. So it's not exactly what Stock Audio thought they were going to get. For whatever reason, they negotiate that if you reduce the purchase price by $100, we'll keep it. And they can do something with it. So from a seller perspective, when that's granted, the entry is to debit that sales returns and allowance account and credit accounts receivable. Okay, so the buyer is not going to pay us, or we're going to reduce the amount they're going to pay us by $100. So we reduce our receivable with the credit to accounts receivable, and the debit in this case goes to sales returns and allowance again. An allowance has no impact on inventory or cost of goods sold since no items are returned. Okay, so that's a key difference on the allowance versus a return. There's no impact to inventory or cost of goods sold. Review question. The cost of goods sold is determined and recorded each time a sale occurs in a periodic inventory system only, a perpetual inventory system only, both periodic and perpetual, or neither periodic or perpetual. The answer is B, perpetual inventory system only. So remember, everything, all the examples we have seen are assuming that it's a perpetual inventory system. If it doesn't state in a problem, if it's periodic perpetual, you assume that it's perpetual and you have to do that inventory cost of goods sold transaction as well. So Costco. Most industry sales returns are relatively minor, but returns of consumer electronics can really take a bite out of profits. At one time, the marketing executives of Costco Wholesale faced a difficult decision. Costco always prided itself on its generous return policy. Most goods had an unlimited grace period for returns. However, they started a new policy that requires certain electronics must be returned within 90 days of their purchase. The reason? The cost of returned products such as high-definition TVs, computers, iPods were cut an estimated 8 cents per share off Costco's earnings per share, which was $2.30. So a pretty decent chunk of that. Online sales have accentuated the return problem. Many retailers have found that to compete, they must offer free shipping for returned goods. Okay, so that's another cost for being able to return those. So if a company expects significant returns, what are the implications for revenue recognition? So if a company expects significant returns, it should make an adjusting entry at the end of the year to increase sales returns and allowances by the estimated amount of the sales returns. This is necessary to not overstate the amount of revenue recognized in the period. So if Costco, sticking with this example, comes to the end of their accounting year, and they would look at what was sold electronic-wise in the past 90 days, look at historically what the returns are, and do an adjustment that they're going to expect within, within that 90-day return period that's going to happen in the next accounting period, the next accounting year. They would also make an estimate for everything else based on what they've sold recently and what they think the return is going to be. So you make an adjustment, you make an estimate and make that adjustment so you can match up your expenses and revenues in the right period. Sales discounts. We looked at this from the buyer's perspective. Now we're going to look at it from the seller's perspective. It's offered to customers to promote prompt payment, so we get our cash earlier. Sales discount is a new account that we're introducing. It's a contra revenue account. So similar to sales returns and allowances, it's going to have a normal debit balance, increases with a debit, and it's contra to the sales revenue. So if we look at this, we have sales revenue of $3,800. We had returns of $300, and we had a sales discount of $70. If we combine these, so we're going to reduce our sales revenue by the 300 and by the 70, our net sales that we're going to show on our income statement is 3,430. So those two contra accounts are reducing our sales revenue to get our net sales. Assume Sauk Stereo pays the balance due of 3,500. Again, that's our 3,800 invoice price less the return of 300. They're paying it on May 14th, the last day of the discount period. So they're going to take the discount, prepare the journal entry. PW Audio, the seller now in this case, makes to record the receipt on May 14th. So remember, when we record payments made by customers that were on purchase made on account from a seller, we're going to show the cash coming in. So we're going to debit cash and credit our accounts receivable because the buyer doesn't owe us that anymore. We're going to do a similar entry, but we're going to have the sales discounts that we have to take into account here. So the accounts receivable credit is going to be for the full amount, 3,500, because the customer no longer owes us that. The cash received is going to be that 3,500 minus the discount amount. In this case, it's $70, and we're going to debit sales discount for that $70. Remember, how do we get the $70? 3,800 minus 300 is the 3,500 that is owed, times the 2% discount is our $70. Data analytics and credit sales. So credit sales, sales returns and allowances, sales discounts all provide rich opportunities to provide data analytics. Effectively analyzing data regarding current and potential customers can help a company expand its sales base while minimizing the risk of unpaid receivables. Companies that refine their customer return policies as a result of data analytics applied to their data on product returns. To achieve the optimal cost-benefit balance on sales discounts, companies statistically analyze past discount practices to determine how large the discount should be, how long the payment period should be, and other factors. So using the knowledge of accounting and how the accounting transactions work, someone can take that data and do analysis on it. So even though you may not be doing accounting, understanding these concepts are going to help you with different roles that you might have in a company. In this case, looking at the credit sales and determining how you should approach your customers with payment period, amount of discounts, how you think about returns and giving allowances and that type of thing. So we're back to De La Hoya and Juno Diaz Company. This example where the Juno, so we're the seller. So we sold goods with a selling price of $1,500. Our cost was $800. De La Hoya returned defective goods with the selling price of $200. Fair value of those defective goods were $30. We're going to record the transactions on Juno Diaz's books. Again, they are the seller, so we're looking at it from the seller perspective. So we make the sale. We're going to debit accounts receivable, $1,500, credit sales revenue, $1,500. That's the selling price, the invoice, what's on the invoice. Then we're going to record our cost of goods sold and inventory. In this case, we had the cost of the goods were $800. That's the value of what we paid or what we had the goods recorded in our inventory as. So we're going to debit cost of goods sold and then credit inventory to reduce our inventory by that $800. So that's the sale that was happened on September 5th, sorry. On September 8th, we had the return. So to record the return, we're going to debit sales returns and allowances for the $200 and credit accounts receivable $200. And then we have to worry about the inventory as well. Defective goods, the fair value is only $30, so we're going to debit inventory $30, credit our cost of goods sold $30. So that's how you record the sales of merchandise and associated returns, any allowances, sales discounts. So now let's look at the steps in the accounting cycle to the merchandising company. So adjusting entries, generally the same as a service company. So the adjusting entries we looked at in chapter 3 are going to be the same, except there's one additional adjustment. So we have to think about at certain times adjusting our inventory to agree with any inventory counts that we do in the actual inventory on hand. Again, the perpetual inventory records may be incorrect due to round recording errors, theft, or waste, and involves adjusting inventory and cost of goods sold. Again, remember adjusting entries, one income statement account, one balance sheet account, and it's never cash. So in this case, inventory is the balance sheet account, cost of goods sold is the income statement account. So let's look at an example. The PW Audio Supply has an unadjusted balance of $40,500 in inventory. They perform a physical count. They determine that its actual merchandise inventory at December 31st is only $40,000. So we have a $500 difference between what our records show, 40,500, and our physical count shows of 40,000. The entry we make to adjust that is to debit cost of goods sold 500, credit inventory 500. So we're going to reduce our inventory from the 40,500 that's on our books to the 40,000, which is the actual count. So to reduce inventory, we credit it. The other side of that is to debit our cost of goods sold. Now you may have an example where your count actually shows a higher amount than what you have on your books. So if we assume that the count was 50,000, and that can happen because you have a return that you didn't record or just errors in recording, you would use the same accounts, inventory and cost of goods sold, but because you're increasing your inventory from 40,500 to 50,000, you would debit inventory and credit cost of goods sold. So just keep that in mind as you do your homework, that it could go the other way as well. And then finally, closing entries. Remember, we close revenue and expense accounts to income summary. Now we're going to expand the expense account side to include accounts with debit balances. So it includes our cost of goods sold, which we said was an expense account, but we're also going to include in that entry the sales returns and allowances and the sales discounts. They have debit balances. Even though they're contra revenues, we're going to close them with our expense accounts because they all have debit balances. So this would be the entry to record the closing of the expense and debit entries into income summary, as well as closing sales revenue to income summary. Then the rest of the process is the same. We're going to close income summary to retained earnings, and then close dividends to retained earnings. And that's our closing entries. So let's look at another example. The adjusted trial balance of Celine Sportswear Shop shows inventory of 25,000, sales revenue, and so on. So number of accounts listed there. We want to prepare the closing entries for the income statement accounts. So what's the first closing entry? We're going to close revenue to income summary. So we look through the accounts to find any revenue accounts. And I see two in there, sales revenue and rent revenue. So we're going to debit those accounts, credit income summary. Remember, if it doesn't specifically say, you're going to assume that the balance given is a normal balance. So sales revenue, rent revenue has a normal credit balance. We assume they have credit balances. and we're going to close those with a debit to those accounts, credit to income summary. Next, we're going to close the expense and debit entry accounts. So we have inventory. Does that get closed with the closing entries? No, it does not. That's a permanent account. It's a balance sheet account, so we're not going to close that. We took care of sales revenue, sales returns and allowances. That has a normal debit balance. Sales discount has a normal debit balance. Cost of goods sold is an expense account with a normal debit balance. Rent revenue we already closed. Freight out, that is an expense account, so that's paying for freight to get the goods to our customers, to our buyer. Rent expense and salaries and wages expense accounts that we've seen before already. Closing entries to close these. We're going to credit all of those accounts because they have normal debit balances to get them to zero. We're going to do that with a credit and then debit income summary. And then the next step would be to close income summary to retained earnings. In this case, we have 168,400 as credits because we closed revenue and $150,000 worth of debit and income summary. So we would have a net income. We would debit income summary, credit retained earnings. Okay, we don't show that in this example, but that would be the next step, of course. Now we'll talk about multi-step income statement. We've talked about some of this already throughout the chapter, but we'll get into more detail of how it operates and what it looks like. So it shows several steps in determining net income. 2 steps relate to principal operating activities, and then we're going to show the difference between operating and non-operating activities. Okay, so what does a multi-step income statement look like? Here's an example here on the right side. The red items are some of the new items or categories that we're looking at. So net sales. Sales is a new category. We saw revenue before, sales revenue up on the income statement, but now we've got potentially sales returns and allowances and sales discounts. So we're going to show that in the sales section to go from our sales revenue, the gross amount, to our net sales. Okay, so remember those are contra accounts, so they reduce our sales revenue to get to net sales. Next is gross profit. So we're going to show our cost of goods sold. We take our net sales minus our cost of goods sold to get gross profit. Okay, so that's a new subtotal that's on the multi-step income statement that we hadn't seen before. Next, we're going to show our operating expenses, similar to what we've seen in a service company and what we saw in previous chapters. So salaries and wages, utilities, advertising, depreciation. Now we've got freight, insurance expense. Those are all operating expenses. We list those out and then show total operating expenses. Then once we have that, we can take our gross profit less our operating expenses to get income from operations. So that's another new subtotal that we hadn't seen before. And then finally, we have other revenues and gains and other expenses and losses. These are things that are non-operating. So it's activities and transactions that the company has, but it doesn't directly come from our operating activities. So it doesn't directly have to do with selling our goods and the expenses associated with selling those. So common things are interest, expense, and revenue. So if we're financing our company through loans or bonds, we're not in the business of doing that. For a bank, those would be operating activities. For most companies, they are not. They're non-operating. We have gain on disposal of plant assets. So we'll talk about this in a future chapter as well. But if you sell your assets of your company, you can get a gain or a sale on those. And so you show those as non-operating. And then this shows an example as a casualty loss from vandalism. So you had some vandalism, someone broke in to your store, maybe broke a window. You have some losses because of that, so that's non-operating. And then finally, we have our net income. So our income from other operations plus our other revenues and gains minus our other losses and expenses gets us our net income. So a quick question. The multi-step income statement for a merchandiser shows each of the following features except gross profit, cost of goods sold, a sales revenue section, investing activity section. So what is not on the multi-step income statement? It's the investing activity section. Another ethics insight. So after Enron, so if you haven't heard of Enron or what happened there, Enron was a big oil and gas company that had a lot of off-balance sheet transactions, which means they were having transactions of the company that they weren't recording on their balance sheet and their income statement properly, and they went bankrupt. I think it was in the late 80s, 90s, I think. But if you haven't heard about that, a great book on that is The Smartest Guys in the Room. Fantastic book that explains that whole debacle of Enron. So if you're interested in that. So anyway, after that happened, they investor criticism, regulatory scrutiny forced many companies to improve the clarity of their financial disclosures, which is a good thing. So IBM began providing more detail regarding its other gains and losses. So it had previously included these items in its selling, general, and administrative expenses with little disclosure. So they showed it as part of operating expenses. So if they sold a building at a gain, they would include that gain in selling, general, and administrative expense line item. So reduce the expense, and then it would look like their operating expenses are lower than they actually were. So another example, eBay sold the remainder of its investment in Skype to Microsoft. It reported a gain in other revenues and gains of $1.7 billion. Total income from operations was 2.4, so that sale of Skype was half of their income from operations. If they would have included that in their operating incomes, it would look like they had $4.1 billion of operating income. So it would distort what that was, that operating income, that true operating income. So why have they demanded more accuracy in isolating other gains and losses? So greater accuracy of the classification, operating versus non-operating, permits investors and analysts to judge the real operating margin and the results of continuing operations, not one-time items, and they can look at the management's ability to control expenses. So we learned about the multi-step income statement, but there you could also do a single-step income statement that subtracts total expenses from total revenues. The company does not realize any profit until the total revenues exceed total expenses, and the format is simpler and easier to use. Okay. So here's an example, that same PW Audio. We looked at their multi-step income statement earlier. This is the single step. So you would just have the revenues. So you'd have net sales, interest revenue, gains on disposal all together to get total revenues. Expenses would include the cost of goods sold, all the operating expenses, plus the interest expense and casualty loss to get total expenses. And your net income is the same, but it's just a different way of getting that. Again, it doesn't always show clearly all the ins and outs, so that's why we prefer to use the multi-step income statement. Now we'll look at the balance sheet for PW Audio. We learned in the previous chapter of the classified balance sheet, keeping with that same thinking and formatting. Inventory that we've dealt with in this chapter is a current asset. We expect it to be turned into cash within a year. So we're going to sell that inventory and collect the cash from our customers within a year. So it's a current asset, and it's shown typically below accounts receivable before the prepaid accounts. So that's just the example of that classified balance sheet. Now let's do an example to prepare a multi-step income statement. So this is for Art Center Corporation for the year ended December 31st, 2027. We have a number of accounts listed there. Okay, and they made it a little easier and haven't listed all the operating expenses. They simply say operating expenses, but remember that could be a number of accounts under there. We have other revenues and gains and other expenses and losses again as totals instead of listing the details within those. So when you see homework, you may have some a similar problem, but then listing some of those. So you need to make sure you know how to classify the different expenses and accounts into those buckets. So what would the income statement look like if we're doing this? And here it is. Sales. So we have sales revenues less sales discounts. We'll give our net sales. Then we subtract cost of goods sold from that to get our gross profit. Once we have gross profit, we subtract our operating expenses. That gives us our income from operations. And then we look at our non-operating activities, or our other revenues and gains, and our other expenses and losses. We add the other revenues and gains, subtract other expenses and losses to get a net. We add that to our income from operations, or if it was a net loss, we would subtract it. But in this case, it's a net gain, so we add it and get our net income. So here is our end of our chapter 5. We learned about merchandising operations, recording purchases and sales of merchandise. We talked about the adjusting entries and closing entries that are different than what we learned before. So it's the same concepts, but we just have a couple of new entries that we have to do with that. And we talked about the multi-step income statement. Please reach out if you have any questions, and thank you for your time.